Hello once again, everyone. It's been quite the ride in August and September, so we wanted to, on this employment day and actually pre-election and the day that President Trump and the First Lady were diagnosed with the COVID virus, we wanted to give you an update on what we're thinking about fiscal policy, monetary policy, market indicators, economic indicators, and the impact of the election on at least innovation strategies around which we have focused all of our research. So we shall start with fiscal policy. Well, we're very close to the election, so the stimulus package, there's a lot of wrangling over it. And we do know that airlines will be the beneficiaries of this next stimulus. And Lord knows they need it because airline travel has been decimated and is coming back very, very slowly. I will say, however, that we are just anecdotally walking around and going to restaurants. We're hearing a lot about labor shortages in restaurants and retail establishments. Because even though the stimulus or the increment to initial unemployment insurance claims has dropped by roughly half, that's still enough to keep people at home and to keep them from returning to jobs that are open. So it's a bit of a conundrum, and we did see today in the employment report, one of the strongest categories was restaurants and leisure and hospitality. So we do believe there will be another stimulus, and we believe it will come before the election, and that should reinforce or reassure some investors who think this is absolutely necessary. We think the economy has hit escape velocity, and that some of the stimulus that is being bandied around is probably not necessary. We also, in terms of fiscal policy, hope that that these policies are not going to get in the way of so-called creative destruction. And what we mean by that is disruptive innovation tends to take off during difficult times. But if companies and industries are being subsidized just to hang on a little longer, that's probably not good for anyone. There are a lot of jobs cropping up right now in the innovation space just because the COVID crisis has unleashed innovation at a rate we never expected to see. And as you know, we expect a lot from innovation. So there are a lot of terrific jobs being created out there. And for those who stick with the old industries that are probably dying, the government might be doing them a disservice by providing funds for those industries. On monetary policy, well, M2 growth is still growing, is still 25% on a year-over-year basis. That is spectacular growth. We don't know what it means yet. I know that it's going to end up somewhere. Many would say it is ending up in the housing market, in the bond market. You'd be surprised when I get into flows later how little has entered the equity market, which is actually quite reassuring from an equity investor's point of view. So we know that, and just the outstanding question is how much of this will flow into inflation. In some ways it already is. We know that lumber prices from their low in March have had tripled. So going from $300 to $1,000 roughly. And they have come in, and we'll talk about that later. But that is a harbinger potentially of what could happen here, that the money will flow to those areas where demand is very, very strong. we're not really seeing it in energy, for example, but lumber, because of the boom, the outright boom in housing, has enjoyed a big run here. And we are hearing the members of the Fed, as they come out and speak, basically repeating what Chairman Powell has said, and that is monetary policy is really asymmetric right now. The Fed seems to be waiting for inflation to move up to 2% and even above 2%. As it moves above 2%, the Fed will not take action right away. And one of the reasons is because it was below 2% for so long. We're not quite sure that that's the right thing to do. It could embed some inflation and inflationary expectations in the system. We know that retailers, for example, like Walmart, are increasing wages. I think they took the minimum wage up to 15% within the past year or so. And they just announced an 11% boost in the last few weeks. Now, I don't know if that's across the board, but that's quite a bit of wage inflation. And as many who might recall the 70s, that's when I started in this business, the concept of wage push inflation dominated the discussion. And in fact, when inflation got into wages, it did become much more embedded in the system. Now, we're not seeing huge wage gains on average across the economy, but these are, again, just harbingers, and we do have to be on guard against inflation. So now on to market signals. Well, the equity market in September experienced some indigestion. I think that's what we believe it is. We had such a big run from March through August, and now we're facing more uncertainties. The election year is one of them, of course. Now that many people, not all, but many are convinced we are in a V-shaped recovery, they're beginning to question, okay, if the election occurs, is there going to be enough uncertainty where we'll relapse? We don't think that will be the case, but that is a source of discussion out there in the markets right now. And of course, many are focused on the so-called K-shaped recovery. And I believe that every recovery is K-shaped, that innovation takes root during tough times, especially recessions, and that the disruption associated with innovation, otherwise known as creative destruction, also occurs, and perhaps at an accelerated rate. So far, we think this is indigestion, and we'll get into what the election means for markets going forward in a minute. Fixed income markets, if you look at both the 10-year Treasury bond yield, it seems flat as a pancake at least in September, as did the shorter end of the curve. So no big change in the yield curve at all. It is pretty positive, especially given the level of interest rates we're seeing right now. So that should be good for financial services. Financial services sector seems to be having some good days and bad days. At least it's not altogether bad. That said, relative to the market as a whole, the financial services sector, I think, is back down near its March lows. Many would suggest that that means trouble for the economy and for the markets going forward. But we believe that the financial services sector is probably right in the teeth of creative disruption associated with digital wallets and disintermediation generally because of fintech, the fusion of financial services and technology. So we're not looking at the drop in financial services relative to the rest of the market as a bad signal. We've been looking at it as inevitable for quite some time. Now, that said, what we're seeing in terms of spreads between higher quality and lower quality bonds, those are moving out again. If you look at the double B versus the triple B, you'll see that that spread never dropped back to roughly the 150 to 200 basis points where it had settled before the coronavirus. It got back down to 250 after hitting a high of about 375 basis points. So 250, we thought it would continue. It didn't. It is now reversing and it is closing in on 300. And we're seeing credit default swaps deteriorate as well. So far, again, you'll hear this mantra quite a bit. We think this is a function of creative destruction at work. There are heavily indebted companies out there that are in harm's way. They're not in the right industries, or they didn't invest enough to catch some of the innovation waves that we're seeing right now. And we've mentioned financial services, certainly energy, any industry exposed to the internal combustion engine, we believe is in harm's way. And again, any company in the pharma, especially the healthcare industry, not embracing new technologies and adjusting to the new world, which includes the convergence of DNA sequencing, artificial intelligence, synthetic biology, CRISPR gene editing, is going to be in harm's way. So far, we think that that's all that the deterioration in these spreads means, but we're watching them very carefully. Commodity prices, to get a sense, copper is the commodity with a PhD. You watch its prices very carefully to see how the economy is doing. Copper prices dropped during the coronavirus crisis to roughly $2 per metric ton. I think that's the metric, and have moved up to $3. It's a very, very nice move, 50% move in copper. It seems to be settling out here a bit, but hanging around that $3 range. That's good. Lumber prices moved from 300, as I mentioned earlier, to 1,000, and have backed down to $600 now. This could be a function simply of supply coming in to meet very strong demand. Housing is booming. In fact, there's a shortage of housing. And so we don't think the drop in the lumber price is a harbinger of housing weakness. If anything, we think there's a scramble out there to bring more supply onto the market. And as you know, the housing is a long lead time investment. So, and then as far as the dynamic funds flows out there, what we're continuing to see, surprising to me, is outflows out of equities. If you look at mutual funds and ETFs, I think last week it was 17 billion, but it's been continuous since, well, for a very long time, but since January of 18 alone, so well before the coronavirus, we began to see outflows accelerate, and the outflows continue. Since January of 18, the outflow from equities has been roughly $370 billion. And that adjusts for share report purchases by companies. So it doesn't include that. This is pure outflows. And the inflows into fixed income, also surprising to me, as you might expect, has been $730 billion since January of 18. Now, as an equity investor, I like that setup. I think there's a lot of fear and trepidation that many investors may feel about having missed the market. We don't think they've missed the market. We do believe the fixed income market has gone into overdrive and has done so well that if we're right on the continuation of this V-shaped recovery into next year, then the fixed income market is probably going to have to follow very strong growth statistics. It was very interesting listening to different commentators, economists, strategists on the employment report today. We will get into that in a minute, but the color out there was negative, and we can pull apart that report and find a lot of big positives in there. So why don't we do that right now? So on the employment report today, first of all, the unemployment rate dropped back, dropped below 8 to 7.9. The consensus was about 8.5. So quite a big surprise. Now, the reason for that was a drop in the labor force. So many are saying this is not because of strong employment, it's simply arithmetic here. Now, and it looked like non-farm payrolls disappointed expectations. I think expectations were at about 860,000, came in around 660,000. But there were big upward revisions to previous months. But more important to us, if you looked at the private sector within the employment report, there was a nice upside surprise. Expectations were 850,000. The increase was 877,000. So a completely different picture from what the headlines were telling us. And the other way of saying that is the big hit was to the government sector in September. So, and we know that state and local governments are under tremendous pressure. They're facing deficits. Many are not allowed to run deficits, and so they are laying employees off. That will probably continue. So we're going to be focused in terms of getting a sense of the underlying health of the economy as much on that private employment number as the total non-farm payroll number. The other interesting positive in the report that we didn't hear anyone mentioning was the increase in hours worked, which is multiplicative when it comes to the strong employment report, 877,000 new jobs. The hours worked went up on average per week to 34.7 from 34.6. Now, again, peeling the onion a little further, the manufacturing sector is on fire. Expectations for the manufacturing job increase were 35,000. What they delivered was 66,000, a nice acceleration from the previous month, which I believe was 29,000. And so what this confirms is something that we've been talking about for a while, is that businesses are having to scramble to catch up with consumer demand. And average hourly earnings are continuing to support consumer demand. They were up 0.1% month to month, which isn't a big increase, but still on a year-over-year basis, they're up 4.7%, very strong by historical standards. And we are also seeing, we got today the University of Michigan Consumer Sentiment Survey. It was up nicely and well above expectations, both on current expectations and future expectations. So even with these uncertainties, the consumer is feeling pretty good right now. And the other number that came out today was durable goods orders. This is the best indicator of capital spending. One component of it is, and that was the non-defense capital goods, ex-aircraft. it was up almost 2%. Now that's month to month, that's not annualized. This is another indicator that businesses are starting to scramble to keep up with demand, first of all, and maybe to embrace some of the more innovative ways to serve their customers. So again, a very good thing. Capital spending has the highest multiplier in the GDP accounts. And so this increase will propagate out there nicely. Now, what about third quarter GDP? If we look at consumption alone, which is about 2/3 of GDP, it looks to be up. It looks like it was up about 39% at an annualized rate in the third quarter. Now, the reason GDP growth may drop below that is because of inventory drawdowns. And by the way, that's a good thing for future activity as the businesses have to catch up with consumers. And so consumer sentiment is a very good indicator for what will happen to consumer activity going forward. And the other good indicator is another number we got this week, and that's the saving rate. So the saving rate did drop from the 17-18% range down to 14%. And that sounds like a lot of the consumers used a lot of firepower. But the consumer saving rate, if you draw a line towards the higher end of the range over the last 10 to 15 years, has been 8%, which is where it was in March before the coronavirus hit. And so that movement from 14% down to 8% could mean significant strength in consumer spending going forward. Okay, so finally, getting on to the election. It is within a month now, and so the markets are focusing very seriously on it. We have taken a point of view about innovation specifically, depending on who wins. The first thing I'll say is that the innovation that is in place right now, based on the 5 major innovation platforms around which we've based all of our research, and they involve 14 different technologies, those have hit escape velocity. They are on their way. There is nothing that the coronavirus crisis turbocharged the move towards these innovative platforms. And we don't think there's any looking back from there. So that's good news. Now, we do need to address the difference between a Biden and a Trump presidency. As far as the Trump presidency goes, we have an idea of what will happen because of the first administration, his first administration. We're probably going to see lower taxes of all kinds, at least proposed, whether that's capital gains, income taxes, a movement towards a flat tax, estate taxes, and maybe even more corporate tax reform, which may streamline the tax code to the benefit of some and to the detriment of others. And so more of the same is what we'd expect, as well as more deregulation. With a Biden administration, given what we're hearing from former Vice President Joe Biden and Kamala Harris, we know there will be higher tax rates of all kinds. And there probably will be a lot more deregulation. I mean, not deregulation, an unwinding of the deregulation and more regulation. Now, just from a pure incentive point of view, we think this will hurt future innovation. And in fact, what it could do is add more momentum to the innovation that I just mentioned has hit escape velocity, because corporations and consumers are probably going to have to look for ways to save costs if their taxes are going up. And we know that innovation is a surefire way to cut costs. It's usually cheaper, better, faster, more productive, more creative in terms of evolving new products and services. So it actually could help those. But we do fear what would happen to future innovation. And what we think could happen is that it would shift to other more tax-friendly regimes in other countries. We've seen this already with blockchain technology. We know that some American investors are not even welcome to participate in some funds that are based in Europe and elsewhere, just because of the different regulatory regimes. And we do feel this would get worse. So from our point of view, given our lens on innovation, we're hoping that whoever is elected, that this recognition that innovation is going to help get us out of this mess, we hope that will resonate. We are sure that it will with the Trump administration. We are not sure that it will with a Biden administration, but we surely will be beating the drum out there, advocating for policies that will accelerate innovation, increase productivity, increase the generation of wealth for all, and create better paying jobs. So with that, I'd like to wish you a wonderful rest of the weekend, and look forward to speaking with you perhaps after the election.